Canadian oil and gas stocks are about to see investor sentiment shift dramatically. It's going to change absolutely everything, a fundamental shift in how this industry works. And it all comes from this article, which is talking about peak oil and the fact that this idea is becoming a bit of an old-fashioned one. And that instead, the International Energy Agency is shifting their projections to what is much, much more favorable for the Canadian oil and gas industry. And that investors who are willing to zoom out are going to see a massive return potential here in stocks that are not valued the way they should be and are going to make a huge amount of profit if they position themselves correctly. So I'm going to tell you exactly what's going on in this article. I'm going to talk to you about what investors have been saying over the last couple of days. I'm going to point out the two stocks that I'm buying to take advantage of this trend. First and foremost, peak oil is dead. That's the story coming out here. The IEA is going to shift their projection this quarter, sometime Q4 2025, and it looks to be huge. I'm talking over 20 million barrels a day up from where they're currently projecting demand to be in 2050. That means that instead of peak oil coming sometime in the next 10 years, we could be looking at a 25 plus year time horizon on peak oil. We could see oil demand continue to grow throughout that time, and we could see long reserve life assets go from something that is a little bit of an anchor to suddenly incredibly valuable. Just think about the way that the idea that peak oil is coming has held this industry back. There's been a huge amount of major institutional investment that did not flow into energy because people were worried. They were worried that these assets would be stranded in 10 years. In this article, they cover this in detail. I recommend you check it out if you have access. If not, basically, the IEA is shifting their projections model. They're going to change the way that they forecast things. They're basically, instead of saying, the stated policy, they're going to look at current policy. So instead of what politicians have said will be policy, they're going to look at what is currently and how that impacts the amount of demand. Obviously, this is a projection. But the thing that's really important isn't if it's true or not. Because let's be honest, none of us know. We can't see the future. And as great as these economists are, and I'm sure they're fantastic at projecting things, they could be wrong. But this is going to change sentiment. And that's almost more important for us as individual retail investors. Because when sentiment changes, industries change. It's almost like a self-fulfilling prophecy here. Because we saw sentiment so bearish on the future, the long term, I'm talking 20 plus year future of oil and gas, we didn't see major investments into things like infrastructure, into new projects, into, long-term contracts. Like, there's been a lot that has been lost because there hasn't been the kind of investor sentiment. And now, when this major international agency shifts consensus dramatically, pushing demand growth and suddenly saying we're going to need at minimum 20 million barrels a day more than we thought in the next 25 years. Well, think about what that's going to do to things like stock prices. Think about what that's going to do to things like, infrastructure projects. Think about what that's going to do to the industry as a whole. We're going to see this industry go from an income opportunity with an expiry date to a growth opportunity overnight. And the way that could move markets is dramatic, and it could move them for the long run. And this lines up so exceptionally well with the existing opportunity here in Canada, because Canada sits at this perfect spot. We see these stocks at low prices. They're being held down by the worries about the short term, by investors who think these stocks have an expiration date, which is logical if peak oil is coming now. But all of a sudden, peak oil isn't coming now. All of a sudden, these stocks can't afford to just sit on their hands, buy back shares. And then there's no expiry date. You can hold them and get that income and get the long-term growth without worrying about that commodity becoming less valuable. And in that scenario, those stocks don't have a 10 PE, an 11, a 12. Instead, those stocks should have a 20 PE, maybe more. And that re-rating, when we see major institutional investors recognize the fact they're offsides, will be massive. Anybody who knows anything about investing in Canadian energy stocks knows this guy. His name's Eric Nuttall. He did a really good job talking about the storyline because he was recently at a major energy investors conference. He was in, downtown Toronto. He's rubbing elbows with all of the folks who are in the know, and the room was electric. According to him, the sentiment is really already shifting. And in this video, he talks about a couple of key elements that are super bullish for Canada. Specifically, he talks about the idea, first and foremost, shale oil is on the decline. It's going to be at least a plateau. It is not going to continue to grow. And at some point, that plateau is going to become a slow and steady decline. That means that yes, in the short term, shale oil is still here. It's not like they're going away tomorrow. But in the long term, all of a sudden there's opportunity. And remember, the long term just got a lot more lucrative. On top of that, according to him and all of those folks he's rubbing elbows with, OPEC growth is peaking. They have cut their existing capacity supply that they were just holding on to. They have put those barrels on the market. There isn't another 2, 3, 4 million barrels of OPEC that they could just throw out there. That's done now. They already did it. And yeah, it's going to damage the short-term price of oil stocks for sure. It is definitely going to do that. But long-term, now there's not this sort of guillotine hanging over the head of the industry, just threatening at any moment to suddenly cut the price down and negatively impact anybody trying to expand, who's willing to invest into new growth. And everybody instead has been kind of working on efficiency and trying to make sure they're in a position where they won't suffer in this exact scenario. Luckily for us, Canada's producers have done that really well. We've got examples Eric gave are like Clearwater producers who are producing barrels at $9 a barrel. So do they really care if they sell it at 60 or at 40? It's still an incredible business model. And even major oil sands producers have safe dividends down into the 40 something dollar WTI, depending on the producer, which means, again, they've been laser focused on surviving this exact short-term scenario. And suddenly the world of financing, of institutional investment are going to open up to them because the long-term prospect is shifting. And that means that these companies suddenly might actually be able to see major oil sands expansion, major growth, real investment into new projects, acquiring new assets. There could be a gigantic bull run in Canada. And I'm talking like we could see millions of barrels a day added to the supply. And in a world where oil prices could be pushed higher by the fact that neither OPEC or the South American non-OPEC, offshore non-OPEC that Eric talks about in this video are likely to add a major additional supply. Again, Canada is uniquely positioned to take advantage. So of course, question you're probably asking, which two stocks did I buy to take advantage of this story? The first one won't surprise anybody who watches the channel. Canadian Natural Resources was already my biggest investment in the Canadian oil industry. It has become my largest single stock investment, period. There's a couple key things that they have that nobody else does. First, size. If you look right here, we're seeing the company's currently 90 billion Canadian dollars. This gives them a couple key advantages. Number one, they're very unlikely to be bought out by somebody else. At $90 billion, there's a tiny number of companies that could theoretically try to acquire this company. And I don't think any of them are going to. And two, it puts them in pole position to acquire more assets. How do I know this? That's been the narrative for at least the last 5 years, if not longer than that. Canadian Natural Resources has scooped up high quality oil sands assets from folks who wanted to leave, again, because they're worried that these long-term assets don't represent long-term value. Well, now with the IEA shifting that projection, suddenly saying you're going to need another 20 million barrels a day, those long-term assets go from undervalued, underappreciated, to suddenly exactly what the world needs. And investors are going to notice. And they're going to look at something like a CNQ and say, oh my God, they have a massive supply. They've got literally decades of high quality production that they're just sitting on at a crazy PE ratio. PE is not the best way to value these companies. People will constantly remind me of that. You should talk about things like price to sales or more complicated ratios. But for the average investor, PE is a great way to look at valuation and look at this company. It's got a trailing 12-month PE of 11. Even in a world where you're projecting brutal oil prices next year and the stock staying more or less flat, you see PE next 12 months at 12. We should be talking about PEs closer to 20 in a world where institutional money is flowing into companies like this and their assets go from negative value or sort of, some income potential right now, but you better get the value out now, because what in the, like all this anxiety, all this worry about their real long-term value, the debate between those folks who believe the IEA and those who don't, all of a sudden to everybody on the same team, these are the best assets on earth. And there's no scenario where that plays out and these assets don't become incredibly valuable. And that valuation of the assets that the company owns doesn't change the valuation of the company. Simply put, there is no scenario where that happens. On top of that, think about the opportunity when it comes to financing and the opportunity when it comes to just expansion. There has not been a real call for expanding the oil sands in a while. I know some folks have wanted to see it happen. I totally know that, right? I'm here in Alberta. I see that every day, right? I exist in those circles. I talk to those folks. Some people want to see it happen, but it hasn't been feasible because the upfront costs are incredibly high and you need a long time for those assets to prove themselves worth it. And, again, financing was split between those who believed that long-term potential was there and those who didn't. Now with the IEA shifting tone, that conflict's not there anymore. Everyone's going to be on the same page and financing is going to be available for new oil sands expansion. On top of that, infrastructure is suddenly going to become a much more lucrative investment opportunity. One of the biggest challenges we face here in Canada is egress, the idea of getting oil from where it's geographically isolated to the major demand centers around the world. Well, all of a sudden, the ability for investors to buy into a pipeline or any other major energy infrastructure that functions essentially as a bond where you pay a huge amount of capital up front and you get your return in the long run, suddenly that becomes much more lucrative because the long run just became much more lucrative. We haven't seen a major proponent for a new pipeline, according to the government. I think this announcement that is coming in the next quarter of this year could change that. And you could see plenty of folks lining up to put dollars up front for a new pipeline. And again, that sounds crazy because over the last 5-10 years, we have not existed in a world where that was feasible. Even the bullish calls folks like myself have made have been pushing against what a lot of folks would consider common sense. It hasn't happened. It's unlikely to happen. We've seen a lot of pushback. There's all this political risk and there's, long-term commodity risk. Why would investors take that risk if they're already dealing with all these other challenges? Well, you remove that big commodity risk. You put forward a scenario where that pipeline becomes incredibly valuable. And all of a sudden, you could see major investors stepping up. That story brings me to the next stock that I think is a really interesting opportunity thanks to this story. That's Enbridge. And honestly, you could zoom out and you could say any of the producers or any of the pipelines, right? I mean, we've talked about at least a half dozen producers regularly here on this channel, at least a dozen in total. All of them will benefit. And lots of them represent fantastic valuation opportunities. Lots of those stocks have really interesting growth potential. Like there's a lot of really cool stocks that I recommend you check out. The only reason they haven't headlined this video is because they don't have the size that C&Q does. But Enbridge has something totally different because Enbridge exists in the world of transporting oil essentially from its sort of origin, from upstream to the downstream, to where it's refined, to where it's exported. And that business has been amazing for decades. But again, like the oil industry, in a world where you didn't need the same amount of resource, there were some question marks about the long term. I'm not talking 5 years. I'm not talking 10 years. I'm talking 25, 30 years. Because there are investors who are looking at something like an Enbridge as something in a retirement portfolio. There are major pension plan investors who need to be able to see these investments grow and provide reliable revenue for decades. And there were question marks about, okay, well, in a peak oil world, would they continue to deliver? But in a non-peak oil world, in a world where oil demand grows and Canadian share in that growth is suddenly boosted, and that idea that Canadian assets are suddenly becoming more valuable and they're suddenly becoming exploited more, there's suddenly this political consensus around it. There's suddenly a real business case and financing to make it happen. Well, companies that transport that are about to become much more in demand. And there's suddenly a massive growth story for Enbridge. Enbridge has already managed to grow its revenues, its earnings incredibly well. but I'm talking real growth. I'm not talking 5-10%. I'm talking double-digit revenue growth for decades more. And that's beyond what Enbridge has already been able to do, which is best in class. This puts Enbridge time horizon at 30 plus years now, instead of the 20 years that some investors are predicting, or even less for those that were bears. I'm talking this is going to completely shift the story of Enbridge, and that shift will be reflected in valuation, just like it will be with the producers. So what am I expecting to happen over the next little bit, and what should investors be doing? Well, number one, I think there's going to become some major shifts in institutional investor sentiment. And I think you're going to see those whispers starting right now. I mean, we've already seen Eric Nuttall talk about it. We've already seen plenty of, news articles dropping. We've seen this sort of general shift when it comes to investments in general. I think there's been a major shift against the sort of anti-fossil fuel lobby in the last year. I think that's going to continue. I think you're going to see that progression continue. There's going to be whispers about it. You're going to see these like mildly bullish articles coming from things like banks, coming from things like asset allocators, right? All these folks that have been completely into renewables and anti-oil for the last decade. I think you're going to see them, sort of trickling along as they have been for the last year. And then you're going to see the projection drop. And that's when all hell breaks loose. Because when that projection does drop, when you see the IEA suddenly revise their projections 20 plus million barrels a day, well, overnight, the calculus on all these stocks changes. You're going to see some things start to move, and you're going to see a lot of headlines. You're going to see a lot of discourse. What I don't want investors to expect, right? Again, I'm not your financial advisor. I'm not telling you how to invest. Don't expect things to jump overnight. They might. Totally possible. Don't count on it. Instead, zoom out. If there's one thing you could do for your portfolio right now that will benefit you, if you're looking at this industry, zoom out, because the time horizon on these stocks just got a lot longer. And because of that, you could see outperformance by a couple percent for decades. And when you see that kind of outperformance in the long term, you could see thousands of percent gains instead of the shorter term. Let's say, even if the stock doubled 100% gain, you could see thousands. And that story is way more appealing to me personally as a long-term investor, and is exactly why I'm picking these larger, sort of more robustly valued, longer-term stocks as my opportunity to play in this market. That's about all I have for you folks today. Let me know what you thought of that video. If you like it, please like it. If you like what we do here on the channel, please do subscribe. I hope I see you in the next one.